If you're a professional, an entrepreneur, or an executive, you're probably paying somewhere between 35 and 45 cents of every dollar that you earn to the federal government. You may have looked at real estate as a way to reduce that, and you were probably told that real estate depreciation losses are passive, meaning they could only offset your passive income, not your salary, not your ordinary income. So you moved on. I want to show you why that conclusion, while correct for most real estate, misses one of the most significant tax strategies available to high-income professionals today. Short-term rentals, like an Airbnb, where guests stay an average of 7 days or fewer, are treated differently under the tax code than other real estate investments. Under the tax code, a property with an average guest stay of 7 days or fewer is not classified as a rental activity the same way that a long-term rental is. That one distinction changes everything, because it means that the passive loss rules that trap depreciation in most real estate investments, they don't automatically apply here. Which means when this type of property is structured correctly, the depreciation losses that it generates can offset your ordinary income directly. Ordinary income means W-2 wages, S-corp distributions, 1099 or self-employment income, or income from K-1s. Here's what that looks like in practice. When you purchase a short-term rental, you can work with the CPA to accelerate depreciation of the property's components, the flooring, the fixtures, the appliances, the systems, into the early years of ownership rather than spreading it out over decades. This is called cost segregation. On a property in the $1 to $2 million range, that process can generate $300,000 to $500,000 in deductions in year one alone. At a 37% federal tax rate, that's potentially $100,000 or more back into your pocket in the first year of ownership. Most people when I talk to have never been told this is possible, and when they hear it, their first call is to their CPA. Now, there is one requirement that makes this work, and it's the part that most people get wrong. It's called material participation, and it sounds more complicated than it is. The IRS requires that you were genuinely involved in the operation of this investment, not just a passive owner who hired someone to handle everything and collected a check. The standard that most investors use requires at least 100 hours of documented involvement per year, about 2 hours per week, and more involvement than any single person that you hire to help you. That means you're involved in selecting the right investment with our guidance. Once it's branded and launched, you're reviewing pricing decisions, approving vendors, directing the property strategy, being in the loop on issues that matter. It doesn't mean answering guest messages at midnight. It doesn't mean fixing a plumbing leak. It doesn't mean being on call 24/7. The reason why most people fail in audit isn't the hours, it's the evidence. Most management companies aren't tracking their time by property, so they can't help you prove that you're the lead decision maker. We built the Dream Investor platform specifically to fix that record-keeping gap. If you want to understand exactly what qualifies and what doesn't, that's the conversation that I have on every fit call. Visit staylah.com/dream or scan the QR code to schedule a time that works with you.